Welcome back everyone to our channel. In today's video, we will talk about the tax write-offs an investor gets in real estate and how you can use it to shape your investment goals, exit strategies, and position yourself to win in the future. This topic is my personal favorite and something I am very proud to share with everyone here. Before we get started, a quick disclaimer slide. I am not a tax professional and you should consult with your CPA before filing your taxes. The numbers and examples are purely based on my experience and cannot be applied across all properties. In my previous video, we covered the five pillars of real estate and how to analyze returns on investment properties. The five pillars being income, depreciation, equity, appreciation, and leverage. In case you haven't watched that video, I'll put a link in the description below. Also, consider subscribing to this channel so you don't miss out on great content in the future. So let's get started and dive deep into depreciation, or simply put, tax benefits of investing in investment real estate. Before we get to the numbers and examples, I would like to share this quote by Benjamin Franklin. In this world, nothing can be said to be certain except death and taxes. This is absolutely true. The certainty of death and the certainty of paying taxes are part of the same sentence. There is no escaping taxes. If you make your fair share, Uncle Sam wants some of it. But then, does real estate get some special treatment? Yes, absolutely it does. The US government recognizes the importance of affordable housing and uses tax incentives to encourage real estate investment in this sector. Some other reasons why tax incentives are offered are because it has a direct impact on the job creation, urban revitalization, and small business growth. In the next slide, I am going to take an example of a single family home and run through some numbers to show you the allowed deductions or write-offs you can take from owning rental real estate. This video will help investors at all levels. As a seasoned investor who might be able to take a quick revision of the Schedule E. If you are a new investor with 1 to 2 single family homes, this video will add value on the write-offs you might have missed for your existing properties and how you can plan your exit strategies to your advantage. If you are a newbie, I would love for you to watch this video and learn. So when you analyze an investment property, you are aware of all the aspects that go into play and position yourself to win in the future. Let's say you buy an investment property, a single family home, and you got it for 375k. You took a loan, so you put 20% down, and your loan amount is 300k. At, let's say, interest rate of about 6%. And since this is for investment, you put a tenant in it, so you rent it out and you charge, let's say, 2300 per month, and you rent it out for the whole year. This amounts to 27,600 per year of income. For calculation reasons, let's just round it off to 28,000 per year. This is your income. Now, imagine if you were to make 28,000 a year income from the stock market. You are going to get taxed at the income tax rate, which is going to be heavy. The advantage of holding a real estate as an asset class is you get great tax benefits, and I've been beating that drum for a while. So today let's dive into what these tax benefits actually are. Now, tax benefits basically are write-offs or deductions, which basically means items that can be used to reduce this amount down. That way, ultimately, you pay very less in tax. I'll go through some of the big or most common tax benefits. I may not cover all of them, but let's get started. The first one is mortgage interest. So for a property or a loan of 300K at 6%, you're approximately going to pay 16,400 in tax. I had calculated this before. If let's round that off for simplicity reasons. Let's say we pay 17,000 in tax per year. The second, the second one, the second write-off that you get is property tax or real estate taxes. Let's say that amount is 5,000 a year. The next one is insurance. Let's assume $1,000 a year. The next one that we can write off is HOA fees, auto fees, like if you were to drive to your property. Um, let's say you spent about $100. Amount is slightly lower, but that's okay. You're likely going to put your property under management and have like a property manager manage your asset. He or she will charge two major fees. One is advertising fee to advertise and lease the tenant, and the second is the management fee. The advertising fee, let's say you would charge $1,000 a year. These are approximate examples, but close to what my experience has been. And management fees, let's say $250 a year. So these are all your deductions. Now, one major deduction before we move on to the major deduction, there's another one called repairs. Let's say upkeep of the property, and I'll tell you why it's called upkeep of the property. Let's say you paid about $500 a year in repairs for your house. The IRS says any fixes you do to the house to keep the house in running condition falls under repairs. Any fixes you do to the house to keep the house, to upgrade the value of the house, like changing granite countertops, changing carpets, changing the roof, do not fall in repairs. They fall in another bucket of capital expenditure. So it's important to understand that, because as and when you get your buy your property, you need to know what bucket things are falling into. So that's why this is called upkeep, to keep the house in running condition. Like, the toilet is broken, the door handle is broken, you need to change keys, that sort of stuff. So I think I covered most of them. The next big expense that the IRS allows is depreciation. What is depreciation? This is, if you go back to the first video, this was one of the key pillars in real estate. um, I'll try to explain this. So let's say you have your house, your rental property, not your primary house, and it sits on a nice land. The IRS says there are splits this into two components. This component is the structure, pardon my handwriting, and this is land. And if you go to like a county website, it is going to split these values. It's going to say the structure cost 250,000 and the land cost 125,000. These ratios can change state to state, county to county. This is just an example. And the thing is, the land appreciates in value. It goes up year over year. The structure depreciates in value every year, because it is a structure after all. So it requires upkeep, and its useful life keeps going down as years go by. So the IRS allows you to depreciate this and not this. So 250,000 can be depreciated over 27 and a half years. This 27 and a half years is something IRS has defined for a single family home. This accounts to around $9,000 a year. I hope that is clear. Your structure is valued at 250K even though you got your house for 375K, because land is valued for 125. So you get to depreciate the 250K for 27 and a half years. Now 27 and a half years is not when the house was built. 27 and a half years is since you start to own the house. So it's from year one of you owning the house. For multifamily, this number is slightly different, and these rules are slightly different. But this is example for a single family. So this amounts to to 250,000 for 27 and a half years. Linearly amounts to close to 9,000 a year. Let's say you change your carpet. Carpet falls under capital expenses. So IRS says that the useful life of a carpet is 5 years. And let's say you spend 3K on the carpet replacement. So you will get $600 per year for the next 5 years. And this one is for the next 27 and a half years. I hope that is clear. So I think I covered most of the major write-offs. Depreciation is a big one. Mortgage interest, again, you see mortgage interest is a big one. So this is the power of leverage. You are leveraging to increase your returns. You're also leveraging to increase your tax benefits. 300K at 6%. I know 6%, or it could be, it was lower for the last 2 or 3 years. So uh, there is something to smile about here. So you get good write-offs from having good leverage. Property taxes, insurance, auto travel fees, or costs, HOA, property management. So I covered most of them. Let's add this up. So we are talking about 17, so 22, 23, 24, 33, 34,000. Let's say round it off to 34,000. So you have 34,000 in write-offs. How can they be used? Let's go back. Your income was it 28,000? Yes, we had assumed 28,000 you get in income. And your write-offs or deductions total to 34,000. This means you are showing a paper loss of $6,000. Remember, this is paper loss. Why is this a paper loss? Because when you got this property, you likely put a tenant, you did put a tenant, and you cash flowed, let's say, $100 a month. That is approximately $1,200 a year. So you might ask me that, hey, these are costs that I actually paid for the house, but that is not actually true. Since you put a tenant, the tenant is who paid for this. The tenant is who paid for the taxes. The tenant, only then will you cash flow. So if you cash flow anywhere, even if you break even or cash flow $100 a month, that means after you have paid for the mortgage interest, the taxes, the repairs, the insurance, the property manager management fees, is when you are left with $100 a month. So that means the tenant has paid these down, and you are getting a tax benefit for something the tenant is paying. This is key to understand. Additionally, the IRS is also giving us another write-off of depreciation. So that totals us to, so even if you made $1,200 a year in, let's say, cash flow, pure cash flow, you are showing 6,000 in loss. And you read these articles of why wealthy people pay no taxes. Why does Trump have no tax returns? That is just because they understand and can use the tax code to their advantage. There is nothing else to it. So now let's say you so okay, so you have 6,000 in paper loss just sitting, even though you made some money. What happens in the second year? So this was the first year, right? So let's go back year number two. This amount is going to, as you know, mortgage interest that you pay year over year reduces. So let's say this amount became 16,000 in year two. Yeah. Property taxes more or less stayed the same for simplicity reasons. Repair stayed the same. Maybe management fee stayed the same. Depreciation also stays the same, 9,000 every single year. So you can see that your paper loss will reduce as mortgage interest, as you pay less and less mortgage interest as years go by, your paper loss is going to reduce. So let's assume year two, you have a paper loss of 5,000. Now you had 6,000 in the first year, you have 5,000 in the second year. Now you're asking me, what do you do? Does it just keep going this way? So I can tell you what you can do with it. So imagine a bucket, let's call it a passive loss bucket, and you accumulate all these losses from year one, year two, and so on. So the first year you had some loss of 6,000, just put it here. Second year you had some loss of 5,000, you put it here, and so on. So next year you'll have some more, you put it here. So you would collect 15,000, let's say, over 3 years in passive losses. Now there are two ways of going about it based on who you are and what you do for your daily work. This side is the passive side. So let's see the passive side. So all your passive investments, real estate mostly. And this side is your W2 side. This is your active income. And let's say you make 400K a year. So let's say, so the question is, can you offset these losses? Can you offset 15,000 of losses against your passive income and pay only 385K taxes on only 385K? Uh, Yes and no. Yes, if this is a short term rental, and yes, if you are a real estate professional. No for everything else. Real estate professional is a status given by the IRS for somebody who spends more than 750 hours a year uh, in actively doing real estate. So you need to be rep status, or you need to have a short term rental portfolio that you are running in which you are showing these losses to offset that income. If you do not fall in any of these categories, what can you do? You can offset it against passive gains. So let's say over 2 or 3 or 4 years, you built a portfolio of 3 homes or 4 homes, right? And let's say you decide to sell one of them, and you can offset the gains that you make on that house with this bucket. So if you had a gain of 30,000 of gains from property one that you decide to sell 5 years down the road, you can empty this bucket and only pay taxes on the rest of the 15,000. So this bucket that you emptied is offsets the gains, and you're left with gains of only 15,000. So you see, instead of paying taxes on the 30,000 gains, you offset that bucket and you pay taxes on only 15,000. So that is the benefit that you can use it for. There are other ways you can save, like 1031 exchanges and whatnot. We'll get to that in another session. So to summarize, paper losses are not actual losses. Cash flow is your actual gain, but paper loss is something you report to the IRS with deductions allowed by the IRS. Um, and this is the real benefit of holding real estate. Um, I do want to quickly mention we spoke about depreciation and the concept of depreciation. There is something called as depreciation recapture. It is an advanced concept. Maybe I'll cover it in the next session. It's basically the government is allowing you a deduction of 9,000 per year for, like, for however long you hold it since the start of the purchase. It wants a percentage of it, of that money back, and that is called depreciation recapture. It is a small portion, but that is, just want to point it out. Now, how I imagine this happening is like, let's say we saw in the example, 34, was it, what were our losses? Our losses were 34,000, the write-offs were 34,000, and our income was 28. So how do you see this happening over, 3 years, 4 years, 5 years? Let's say you just have one single property, and you had paper losses of 34K, you had an income of 28K. This is how you were able to show a loss of 6K. You enter year 2, because your write-offs reduce, mortgage interest reduces, this this value, this write-off value is likely going to reduce a little bit, let's say 33K, and you are going to increase rents every year. So let's say this became 29K. Now your new loss, passive loss, for this is year 1, for year 2 is going to be 4K. And you start to see a trend as years go by. This line is going to be slowly going down, and this line is slowly going to be going up. I hope you are able to visualize this. And you can see year 3, this gap is going to be slightly less. This gap is going to be slightly less. This gap is going to be slightly less. So year 1, year 2, year 3, year 4, year 5. Let's say at year 6 is when the write-offs you take and the income you make both match each other. That means you have zero paper losses here for this year, year 6. Any point after this, your income is going to be higher than your write-offs. But will you start paying taxes? Not yet. Why? Because you have this big bucket sitting here of 6K, 4K, 3K, 2K, negative 1K. So you have this big passive bucket sitting here, 10, 15, 16. So you have 16K of passive losses that you have accumulated over the last 5 years. 1, 2, 3, 4, 5. Any income you start to make beyond this point can be used, and the passive losses can be used to offset that income. So year 7, let's say you make a gain of 2K. Now your new bucket, you don't pay any taxes on this because you have a passive loss sitting here. So now your new passive loss is 14K. Next year you make 4K. You offset that, pay no taxes, offset it, and now your new loss is 10K. So you keep going. So you see the trend. So the time when you are actually going to start paying any tax to the IRS for your rental income is going to be probably year 8, year 9, year 10. So you enjoyed cash flow for the first 8 to 10 years without paying a single penny in tax to the IRS. And that is the beauty of holding an investment real estate asset class. I my details, I hope I did not confuse you, and I hope I put some thought, that you can think about in terms of helping you save on taxes. If something is not clear, please email me, please message me, let's talk about it. um, Otherwise, yeah, thanks for listening. So if you guys are here now and still listening to what I'm saying, you have really heard like the advanced tax concepts, barring some multifamily stuff. From here it just gets build on what you have already heard and just keep going from there. So kudos to you for being with me until here. And any questions, yeah, please email me, please message me, let's talk about it. Until then, yeah, bye, see you next time.